Matt, so good to see you. We start with an important question. Are you taking on too much risk? We have four signs that you might be. Risk isn't just about the numbers, it's about how you feel when market conditions change. So let's talk through those four signs that you may be taking on more risk than you should. Number one, you check your accounts constantly, but how often is too often?
If you're looking at your account every 5 minutes or every day, Aaron, you're going to go crazy. You're not going
Yes,
to
that's
sleep at
true.
night. It's going to be a rough go. In fact, for most people, I'd say even weekly is too much. Ideally, I mean, once a month, once a quarter. In fact, Fidelity did a study years ago on their best performing accounts, and they were
Mhm.
just trying to figure out why this batch of accounts was just outperforming everybody else. Aaron, do you know what it was? It was
No, tell
clients
me.
it was clients that forgot they had an account, and they
Wow.
just let it grow from decades to decades, and that's how you win. Stay invested in the market.
That's funny. All right, next, ask yourself, do you lose sleep when the market drops? That being said, which probably is related to that study, sometimes it's really hard to tune out those headlines.
Yes, as you know, Aaron, the headlines are really geared towards reaction, right?
Yeah.
It's how it is today. So you got to tune that out. You got to stay out of the feeds. In fact, years ago we talked about a study where 100 reasons why not to invest in the stock market. Stock market's up, stock market's down. Every year there's some doom and gloom headline. You just have to tune it out, stay in, because over time the market wins. Look at this. Yes, the dot-com in 2000 market dropped, but our investments are designed and factor in market volatility. Market volatility is your friend while you're accumulating. And we want to stay invested over time because over time the market wins.
Yeah, really good point. All right, third sign you may be taking on too much risk. You've made panic driven decisions before. This is known as emotional investing. And the best way to explain this, Matt, is through the eyes of George Costanza. What's he say?
Our good friend, if every instinct you have is wrong, then the opposite would have to be right.
Right.
There
And
we
how does
go.
that relate to emotional investing?
Well, we don't want to be chasing last year's winner, right? So we want to stay in the market. Here we are with the emotional chart for investing. We start out with optimism at euphoria. We think we're going to be, millionaires and trillionaires overnight. And then before you know it, the market tanks, and then it's the opposite end. But keep in mind, this chart just doesn't reflect how this is a good picture of the market, and not just the market as a whole, but as different sectors of the market. Like right now, gold and silver is going crazy, right? And people want to get on in gold and silver, and I get that. But
Yeah, I'm glad you
everything
brought that up because that is sign number four, which is when you feel pressure to chase those returns, AKA FOMO.
there we go, and that's where we're at right now, and that's where we're going to be in 6 months with a different sector of the market. Last year's winner is not going to be next year's winner, most likely, right? So this chart, the Callahan periodic table of investment returns, the idea here, Aaron, is I want you to look at the chart, and each color code is a different sector of the market, right? So red is real estate, and then the darker blue is large cap equity. You look at that chart, and you tell me, where should we put all our money year in, year out? Which one is the winner over time?
Yeah, right.
And
No,
after you stare at that chart a few minutes, you realize there is no one winner that is one sector that's the winner year after year.
right, right,
Real estate was the winner one year. Next year, it's the loser. The
right,
point is, we want a balanced portfolio that is diversified to help you win throughout various market cycles.
right. So I feel like this conversation, Matt, kind of begs the question, how can working with a financial advisor help us stay in line with our risk tolerance?
Well, obviously, we're going to keep up with that risk tolerance, and if you're conservative, we're not going to put you in the S&P 100% in the S&P 500. We want to recommend investments that are based on your risk tolerance. So if you're moderate, we're going to go moderate. And as you know, Aaron, at Brookstone, we have investments that are very advanced and are designed to give us a good rate of return, or rate of return based on our risk profile, often with reduced risk depending on the allocation. So that's what we're here for. We have the most advanced investments in the marketplace, and we can put a plan together for you to help you sleep at night throughout retirement.
Right. And I'm so glad you brought that up, because it does come back to peace of mind. When you know you have a plan that is based on data as opposed to just the whims of how we feel that day, you know that the plan will carry you through that volatility. So, Matt, if somebody would like to sit down with you, because maybe some of these signs sound a little bit familiar to how they're feeling right now, what's the best way to reach you?
Give us a call at 425-256-3105, and we'll get together. Looking forward to work with you.
All right, Matt, thank you so much for your time today. I appreciate it.
Thank you, Erin.